Russia and China just took a dramatic step away from the US dollar, rattling global markets. They're forging fresh trade deals and settlement systems that bypass the greenback, shocking many who assumed the dollar would always reign supreme. Could this shift redraw the world's economic map? Leaders in Washington scramble to respond, while investors everywhere wonder if we're on the brink of a new financial era. Strap in, because the stakes couldn't be higher, and the rest of the world is watching to see who follows next. Talk of de-dollarization has circulated for years, but recent moves by Russia and China make it feel more real than ever. Both countries openly discuss using their own currencies or alternative arrangements for global trade. They're no longer content to rely on the greenback, especially after the US and its allies froze Russian assets and cut off some Russian banks from SWIFT in response to the Ukraine conflict. From Moscow's perspective, the dollar is a liability, vulnerable to sanctions. Beijing, equally wary of Western pressure, also sees an opening to expand the yuan's global reach. In the past year, trade between Russia and China skyrocketed, surpassing $190 billion in 2022, a 30% jump from the previous year according to Chinese customs data. Analysts at the Peterson Institute for International Economics say at least half of that trade is no longer settled in dollars. Instead, the ruble and yuan dominate the transactions. This is no minor tweak. This is a major reset in how two massive economies do business, and it could accelerate if other nations follow suit. For Russia, the motivation is crystal clear. Sanctions from the US and Europe turned the dollar from an asset into a risk. After major banks got cut off from SWIFT, Russia found it hard to transact in dollars or euros. Oil revenue, once mostly priced in dollars, had to find new pathways. A bar chart from the Bank of Russia shows the euro and yuan now make up a larger slice of the country's foreign reserves, while dollar holdings slid significantly. China's logic is more strategic. Beijing isn't under the same direct sanctions as Moscow, but it's locked in a broader rivalry with Washington. Tensions over tech exports, Taiwan, and trade deficits loom large. By reducing dollar dependence, China gains autonomy. It also tests whether the yuan can grow into a global reserve currency. Some experts call it a long shot, but each step away from the dollar signals intent. China wants a bigger hand in shaping world finance. For years, the yuan, officially the renminbi, struggled to gain acceptance for major cross-border deals. Capital controls in China discouraged free flows of currency, limiting the yuan's use. But Beijing has steadily chipped away at these controls in certain pilot zones, and it's signed currency swap agreements with over 40 countries. More nations now hold yuan in their reserves, though it's still a tiny fraction compared to the dollar's share, around 58% of global reserves. The new data from SWIFT, the global financial messaging network, reveals the yuan accounts for about 2.5% of international payments by value as of mid-2023, up from under 2% a couple of years ago. That's still small, but the growth momentum is real. If Russia's pivot fosters a broader acceptance of yuan-based trade, the currency's global footprint could expand more quickly, especially if other sanctioned or sanction-fearing states join in. Western sanctions on Russia's banks and oligarchs provided an unexpected boost to the yuan's position. Once cut off from dollar clearing, Russian businesses had to find alternatives. China's banking system, less bound by Western rules, offered pathways to keep selling energy, metals, and agricultural products. A line graph from the Russian Ministry of Finance shows ruble-yuan trade volumes soared 80-fold between early 2022 and mid-2023. Meanwhile, some Russian companies, like major oil producer Rosneft, started pricing contracts in yuan or rubles. Others used middlemen in places like Hong Kong, the United Arab Emirates, or Turkey to settle payments. The result? A partial de-dollarization of Russia's export economy. Washington might not have expected the shift to happen so fast, but many experts say it's far from total. Oil is still priced largely in dollars globally, and complex supply chains often rely on Western financing. Even so, the cracks in dollar reliance are growing. Unsurprisingly, Washington is uneasy about losing financial leverage. Controlling dollar-based transactions has long been a key foreign policy tool. Witness how the US can sanction countries by blocking them from dollar clearing. If major players systematically avoid the dollar, that tool weakens. Some in the US government shrug it off, pointing to the massive size of US financial markets and the dollar's role in everything from oil pricing to global debt. They argue de-dollarization is overhyped. Yet a vocal minority in policy circles warns that complacency could be dangerous. If each new sanction pushes countries to find workarounds, eventually the dollar's dominance could erode. A memo leaked from within the Treasury Department acknowledges the long-term risk of global fragmentation, though it downplays near-term threats. On Capitol Hill, a few legislators push for more diplomatic engagement with BRICS nations to keep them from pivoting away from the dollar. That might be easier said than done. Russia and China are two members of the BRICS group, which also includes Brazil, India, and South Africa. Collectively, they represent over 40% of the world's population and around 25% of global GDP. In August 2023, the BRICS summit in Johannesburg highlighted calls for a new payment system or even a joint currency for internal trade. While India and Brazil are cautious, both have strong ties to Western finance, they too want to reduce dollar dependence over time. If the ruble-yuan arrangement becomes a blueprint, other BRICS nations might adopt similar measures. For instance, Brazil and China already agreed to settle some trades in their own currencies. An official from the People's Bank of China told local media that they foresee a multi-currency system by 2030, where the yuan, rupee, and real play bigger roles in cross-border deals. That's not a direct assault on the dollar, but it chips away at its monopoly. Energy is at the heart of global commerce, traditionally priced in dollars. Russia, one of the world's top oil and gas exporters, has begun accepting yuan for shipments to China. A few other energy producers under Western sanctions, like Iran and Venezuela, also explore non-dollar deals. If the trend grows, we might see a partial shift to a petro-yuan, at least for certain routes. According to a statement by China's National Petroleum Corporation, about 10% of Sino-Russian oil trade in 2023 was settled in yuan, up from near zero a few years ago. Saudi Arabia and other Gulf states watch this carefully. Some have hinted at pricing oil in yuan if it benefits their strategic ties with China. Saudi Arabia alone supplies over 15% of China's crude imports. A shift might be slow, but the possibility worries dollar hawks. If a chunk of Middle Eastern oil trades in yuan, it undermines the petrodollar system that's anchored global finance for decades. So far, the dollar remains strong by many measures. The US economy is large and stable compared to many rivals. Treasury bonds still attract foreign capital seeking a safe haven, especially in times of crisis. But de-dollarization chatter can shake markets if big players like Russia and China keep diversifying reserves. Already the Bank of Russia sold a large portion of its treasuries in 2018, and further divestments took place after the Ukraine sanctions in 2022. The People's Bank of China also trimmed some US debt holdings, though it remains a top foreign holder. Investors worry about potential spikes in US interest rates if major foreign holders unload treasuries. A bar chart from the Federal Reserve shows foreign ownership of US government debt dipped from 32% in 2015 to around 26% in 2022. That decline is gradual, but each sanction crisis might speed it up. If yields rise, it becomes costlier for Washington to fund its $31 trillion debt. Meanwhile, gold soared above $2,000 per ounce multiple times in 2023, partly due to central banks led by Russia, China, and others, stockpiling gold as a hedge against dollar volatility. Experts say dethroning the dollar remains a tall order. The greenback is embedded in global finance, from trade invoicing to central bank reserves. No other currency offers the same liquidity and trust. Even China's yuan faces hurdles: capital controls, lack of transparency, and limited global usage. The euro, yen, or British pound can't match America's scale. Some predict a multipolar currency system eventually emerges, but it could take decades. Yet the question is how much the dollar's dominance might slip. Even a 10 to 15% reduction in dollar-based trade or reserves would be huge given how big the global market is. Freed from the threat of sanctions, countries might prefer local currency deals or a basket arrangement. Over time, losing the exorbitant privilege of dollar dominance might raise borrowing costs for the US and reduce America's ability to project power through financial channels. That's enough to keep policymakers up at night. If Russia and China keep forging alliances with other countries fed up with Western sanctions, think Iran, some African states, or even parts of Latin America, they might build a robust, parallel financial network. The Shanghai Cooperation Organization and BRICS could formalize cross-border payment systems that bypass SWIFT, using new digital currencies or direct bank links. That might accelerate regional supply chains that exclude US oversight, fundamentally reshaping globalization. On the flip side, the United States might double down on pressure, imposing more sanctions or restricting technology flows to hamper such networks. This could escalate into an economic Cold War, fracturing supply lines. Large multinational firms might have to pick sides, or at least adapt products for two separate financial ecosystems. Consumers worldwide could see higher costs and fewer choices. The climate for cross-border investment may dim. So are we witnessing the start of a permanent shift away from the dollar, or just a short-term reaction to the Ukraine conflict and US sanctions? Right now, data suggests partial moves, but not a total replacement. A multi-currency world might emerge gradually, with the dollar still important, but no longer unchallenged. If the US remains stable and innovative, investors may keep favoring dollars. But each geo-economic crisis pushes countries to weigh alternatives. Should the US worry? Absolutely, say some economists, especially if it continues to weaponize the dollar. Others argue the US can handle partial shifts if it remains the largest consumer market with strong rule of law, but ignoring the ambitions of Russia and China might be risky. They're not alone. Many global South nations resent Western dominance and crave more choices. If a new financial order gains traction, Americans might find they have less global influence than before. The next months will be telling. If more deals between Russia and China bypass the dollar, watch for signals that other countries want in. If Saudi Arabia and the Gulf states open the door to UN-based oil pricing, that's a major milestone. Meanwhile, keep an eye on how the US addresses alliances. Europe may side with Washington on security issues, but resent extraterritorial sanctions. The fundamental question is whether the dollar will remain the uncontested anchor of the global economy, or become one of several major currencies in a new multipolar era. Fresh rumors claim a major OPEC member is about to ink a UN-based energy deal, following Russia and China's lead. If that rumor goes public, it could rock currency markets overnight. Maybe even mark the beginning of the end for dollar hegemony. Will Washington pivot to prevent this domino effect, or are we entering a whole new financial landscape? The next big announcement could change everything we know about money and power on the global stage.